Buying a home with student loans using a conventional mortgage. Hi, I'm Kevin Jefferson, the People's Lender, NMLS number 1433853. Today we're going to discuss purchasing a home with even though you have student loan debt, using a conventional mortgage. So typically when you use a conventional mortgage, they're very conservative. They look for higher credit scores and typically lower debt to income ratio. Now, debt to income ratio, as explained in my previous video, is where we look at what comes in on a monthly basis from the borrower and what goes out on a monthly basis, including current expenses and new housing expense. Now, with student loans, there's three things that you can have to qualify. You can have an income-based repayment plan, which is where you're on a repayment plan to pay a certain amount that's set at least for 12 months, and we can document it. If you have $100,000 in student loan debt and your income-based repayment plan says you pay $300 and we can document it, that is the payment that we can use as a debt against you, even though you currently have $100,000 in student loan debt. The next thing is a fully amortized payment, meaning you're not on any set repayment plan, but you're on a steady payment for the life of the loan from payment 1 all the way to payment 240. That is whatever the payment is. If that payment is $700 a month, that payment does not increase or decrease. We can document it. We can use that to go into your debt to income ratio as a debt against you. The third option is if you are currently deferred because either you're using deferment time on your student loans, or if you are currently in school, then you can use 1% of the balance. Now, on $100,000 in student loan debt, 1% of the balance is $1,000. So that is on the higher end of the spectrum. That's the highest payment. The reason why it's set up that way is specifically so that Fannie Mae or Freddie Mac can see that you can pay a student loan debt and a mortgage at the same time, because student loan debts, if not paid and they go into default, they can become judgments. And then once they go from the judgment status, they can go into lien status. And by going into lien status, it has the ability to supersede the mortgage and they can foreclose on the house. So a lien can supersede a current mortgage and go against the house. Now, some people don't think you can purchase homes with student loan debt. However, with those three student loan payments being calculated into your debt to income ratio, that will allow for us as the lender to figure out how much you can qualify for. Obviously, if you have $1,000 student loan debt, you're going to qualify for less than if it was $700 or the $300. Obviously, if you have a $700 a month amortized payment, that's going to allow for you to qualify for less than you have $300. Now, is there a set amount that needs to be in there? And this is very, very critical. If for some reason you have an income-based repayment plan and that repayment plan says that your payment is zero, you can, in fact, as long as we can document it, use the $0 to help you qualify. Now, steps of what you need to do. You want to make sure you get in contact with your student loan servicer to see which payment plan you have and what your options are. A quick and easy way to remember: if your income-based repayment plan is less than your 1%, the 1% rule that conventional uses, just take 1% of your student loan balance. And if you don't know what your student loan balance is, ask your servicer what the student loan balance is. Take 1% of that and then ask them what the payment would be on a income-based repayment plan and see which one is less. Just remember, the less the payment, the more house you qualify for. If you like this information and want to know more about student loans and how to qualify, check out my next video on how to qualify for student loan debt using the VA financing. And if you haven't already, please share, like, and subscribe. And if you have any questions, comment in the bottom. Thank you.